equivalency model. And the equivalency model in your strategy, and remember we have a strategy with 4 dimensions, and just to repeat, dimension 1 is your organic market, and that's the market where you initiated. These are your first customers. These are because of geography or location or some other factor is your natural market. And then we have sector analysis where we analyze how is the sector behaving, where I'm in, and we see public policies and also gaps on market systems, right? And then we have a third dimension upon that analysis where we develop partnerships. And then the fourth dimension is the financial model that it's ad hoc developed for each one of the strategies. Okay, so, but here, you can be a company with having strategies, your strategy covering more than one dimension. It could be in 2 or 3. It depends. And here's the difference. As you can see, in the organic market, your results tend to be fully implemented by you, but they tend to be a little smaller. Okay, so on the book Partnerships and Networks, I developed a matrix where you can measure this, and this is something that it was developed. So you measure the financial situation of the product or service, and then the impact that it's having. And then with that, you get a sense of the market share and which are the winners, which are the strategies that are really working, and which are the ones that are lagging behind. It can help you design a strategy to fill gaps, so those products and services, behave or they produce better results. So basically, this is an analysis you can find in my book, Partnerships and Networks, and it'll give you an idea of what is it that you're measuring. Then, as you can see in dimension 1, you have a secure result, but it tends to be smaller than if you go here, right? So here is the equivalency number. As you move away from the strategy, the dimension 1 strategy, you lose control, but the results can be equivalent to 1 in dimension 1 to 100 in dimension 2, right? And that is because when you enter either public policy that impacts a lot of people or market systems that also impact a lot of people, because we're all participants and actors in one or the other or in both in most of our daily lives, then you also get the power of the market, right? So let's say you move to dimension 2, you have a business, going back to the financial institution, you have a financial institution, you have these loans that you provide. Well, then you move to dimension 2 and you say, well, who else? Remember we were mentioning that, and we said, is there another geography where this model of dimension 1 can also be applied and be successful? Or is it some gaps on the delivery of certain services that the government and the state is providing to the citizens? So we said you need to look at those and you can provide. And we said that in the case of the financial institution, it was a fund to guarantee loans so more people could apply and successfully repay. And this is because, again, we knew that some people weren't going to repay, but we didn't know exactly who. And we could be punishing a lot of people by saying, well, all of those don't apply. Instead, here we design a technique in a fund to guarantee losses. So you guarantee those losses knowing that they're very small, but you also let the process continue for the rest of the people that will repay. So those kind of solutions tend to increase the market. 100, it could be, it could easily be. Then on model 3, on dimension 3, what you do is you find strong partners also. So for instance, here it would be, okay, so I design the guarantee fund, but I want to grow even more. So let's say that I design this fund to guarantee the loans with one bank, right? And it's my bank, etc. So what if I want to use and provide the service to other banks and to other microfinancial institutions, right? So you are on dimension 2, but you are on dimension 3, and you sign 10 partnerships with 10 different banks that are like the original one. So you're going to have increase in your market share is going to go even bigger, right? So that's the equivalency number. Now, it's also important to see that as you lose control, there are certain factors that you are not going to control. So because of that, you also have to put that into your risk analysis. So for instance, in this case, it would be for the microfinancial institution for this service of a guarantee fund, a fund to guarantee losses. Well, one hypothesis is that there's going to be funding for loans, right? So you're not going to manage that. And there is no lending. Let's say there is a crisis and there is no lending. That dependency, will mean that even that your product or service is really great and it really helps a lot of people. It requires for people to be asking for funding and to have funding available. But then again, if that would happen, another intervention could be done, and I'm sure it happens. So if that were the case and there's no funding, well, maybe you could come up with another solution in order to get the funding. You see, so the context of the marketplace has to do with that. But as I said, you got to understand that there is certain dependencies. You should analyze them and put them into your risk analysis, and then come up with some kind of mitigation measures that will help you manage the risk. So the equivalency, as you can see, the equivalency, that's the secret. As I said, you can move to dimension 2 and have some growth. Going back to the microfinancial institution could have said, I can double the loans that I'm providing if I move to this other neighborhood, city, country, where it looks like this service may work, right? So you can double. Let's say you can quadruple. But at the end, if your product, if that fund, right, that guarantee fund is really, helps a lot of people and solves a lot of issues, then you can put it in a lot of different scenarios, and that's really the secret. So it's the same with here is the same. Okay, so let's say that there is that solution, right? So you're in a sector and you have a gap, but there isn't a solution. There isn't a solution as easy. You haven't been able to come up with it, etc. Well, then that's when you move into entrepreneurship. And that's when you take advantage of those strengths and those forces. So who would be your ideal partner there? Well, it would be maybe an organization that helps startups, Startup Chile, Startup Costa Rica. There's different startups or organizations that help startups. So I would definitely do that. Maybe even see if there is a need to incubate.